Healthcare Headlines. I'm Amber Walsh. I'm joined today on Healthcare Headlines by three of my healthcare debt finance partners. Raj Natarajan and Naho Kobayashi are together on the screen there. And then our other partner also joining us is Gerum Yilma. On Healthcare Headlines, this series has addressed what's going on within the healthcare industry from a variety of stakeholder perspectives. We started in 2020 in the midst of the pandemic and have continued it on in 2021 to kind of see what's going on right now and how these various stakeholders have been impacted in the short term and the long term by the pandemic. So today, I'm really pleased that Raj and Naho and Gerum are going to give you some perspectives from healthcare lenders, those who provide credit and capital for healthcare providers, pharmaceutical manufacturers, device manufacturers, etc. So thank you all for joining us.
Thank you.
Thank you, Amber.
So I'm going to start by having each one of you introduce yourself and your practice. And Raj, as the chair of the McGuireWoods Debt Finance Group, I will have you just kick us off and then turn it over to Naho and then Gerum so that we get to know you a little bit.
Sure. Thanks, Amber. We appreciate the opportunity to participate here. I'm Raj Natarajan, as Amber said. I chair our debt finance team here out of Charlotte, but with offices on the team in over a dozen. We've got about 83 to, depending on the day, 83 to 85 lawyers in the group. And while a large group of us focus on healthcare finance and life sciences finance, we really cover all types of industries and all types of deal types. So with that, I'll hand it over to Naho.
Thanks, Amber. Appreciate the opportunity to have a chat with you today about the healthcare finance industry. That's where I've practiced for the last over 20 years. I'm not going to say exactly how long, but really excited to spend a few minutes chatting with you and the rest of the folks here today.
All right. Thanks, Amber. My name is Gerum Yilma. I'm in the Atlanta office. I'm also on debt finance, primarily practicing in healthcare for the past 12 plus years.
So Gerum, I'm going to stay on you for just a minute to kick off a discussion on the healthcare lending deal landscape. And I really want to focus in on where our McGuireWoods healthcare debt finance and equity teams really spend a ton of our time, which is in the lower middle market for healthcare deals. We all see, it doesn't matter if you're on the equity side or the debt side or the regulatory piece of the healthcare deals, we are seeing a ton of volume. And love for you to just share with us what you're seeing right now from a lender perspective in terms of competition and volume and all of that.
Sure, thank you. So, I think arguably this is probably the busiest M&A market we're seeing, at least in the past decade, as far as I can remember. What we're seeing really differs depending on which lender, what market you're in. If you're talking about a traditional bank, the terms, still are not as aggressive as what you're probably seeing in the large market, in the large cap markets. But on the flip side, the debt is much cheaper. The structure is more traditional. If you're talking about a non-bank lender, they've got a lot more flexibility. So the structures are more sponsor friendly. They've got more capacity to have more aggressive terms, but in turn, you pay for that. The debt is going to be more expensive. So it really depends on what lender you're dealing with and what market you're in.
And if I could chime in on that, I think leverage is a big key. The amount of debt
That's right.
Over the amount of EBITDA or revenue is really key because the higher that goes, it automatically kicks certain lenders out of the market. That you have to go to lenders who are allowed to provide higher leverage debt that costs more in a number of ways. It could cost more not only in interest and upfront fees and pricing, but also in potentially getting equity, what we call equity kickers or sweeteners. So it really depends on what the company looks like.
Yeah,
Mhm.
and not every target is the same. Not every acquisition has the
Right.
same deal terms. For an aggressive sponsor-led deal, execution usually is the key that they look at when they're picking lenders. So if the sponsor already knows that there's going to be a lot of hair on this, leverage is going to be higher, then automatically the lenders that they're going to look to for financing is pretty limited. But there are many lenders in the market right now, both on the bank and non-bank side. So there's plenty of choices, but it just depends on what the deal term requires.
When there's a lot of pressure for our lender clients to put capital to work, and and not as much deal flow as they'd like to see. Certainly not as much deal flow without issues, right? I mean, it's rare you get a completely clean $20 million EBITDA company with 3 times leverage. I mean, good luck, So, I mean, we're looking at things, particularly in the lower middle market, that may have been, the founders are still the owners, and so they're flipping to the first time private equity market. There's stuff in there. There are, some things we got to mitigate. And so, but there's still, because there's so much pressure to put capital to work, debt capital to work, you're seeing a lot of lenders willing to roll up their sleeves. Before, maybe even 5 years ago, everyone said, oh, we don't do deals lower than 10 million EBITDA. We don't do deals lower than 15 million EBITDA. And now we see a ton of lenders going below that. And we see a ton of lenders focused below that who are like, no, we're 1 to 5. We're 5 to 10. So there's a lot of debt capital out there. And I think a lot of pressure, from their LPs or otherwise, or investors or otherwise, to put that money to work.
And I think this goes back to what Gerum said in the beginning. The nature of your lender is really going to matter, because, if you're dealing with a highly regulated bank lender, they're going to have some considerations that are going to come into play in terms of the amount of risk that they can take and the assets they can look at. And so, that's definitely, I think Raj is 100% right. I have been seeing lenders who maybe 5 years ago would not look at deals that had 10 or 15 million EBITDA, moving into that space. But, again, that gets balanced. So there's a different set of internal criteria that they have to operate under versus, say, a direct lender that doesn't have those regulatory considerations when looking at some of the same deals.
Yeah. Well, there are sub-industries where certain lenders just will not touch it. They've been burned on it, maybe burned on it too many times. They've taken a loss or a complete loss, gotten out at 50 cents on the dollar or something, and they're just like, we're not going back in that market. Even for healthcare lenders, there are certain subsectors that they won't touch. Not many, but a few.
It's interesting hearing your dialogue. And Raj, you mentioned the lenders who are going sub $10 million EBITDA. You now have healthcare specialty funds who are raising funds specifically targeted at single EBITDA acquisition targets. And with really sophisticated investors coming out of very large funds, it's really interesting that has been such an identified area of focus within healthcare investments, no matter where you sit in there.
And sometimes just the number of times they've done a deal in that space. If this is like your 20th or 30th home healthcare deal, you're likely to be more comfortable with a lower EBITDA even on an adjusted basis, because you can see some of the risks and you see what the potentials are. But if this is really your first home healthcare deal, you may not get there in time for the sponsor. It just depends.
Well, and another thing to add on that is just relationships. I mean, at the end of the day, this goes back to, do we trust you, sponsor? Do we trust you, lender? How will we act, vis-a-vis the other in a down scenario? We have worked with a lender client that has worked with a sponsor for 15 plus years. And that sponsor is going to go to our lender client first every time, and they've had some down scenarios, not a lot, but they've had some. And when they have, they worked well together, right? And that to me, it's not contentious in those. There's discussion, right? But they're willing to talk about issues. They're willing to talk, openly about it. A sponsor that's willing to come to the table and identify a concern or an issue, even if it's not a default, to say, here's something we're thinking about, is really going to gain a lot of trust from the bank group or for the single lender, what have you. And again, that really creates a great relationship and pipeline of committed capital, not specifically committed capital, but they're going to be there for you. And that's something that lender or bankers are always looking for, is a trusted sponsor that our institution likes, that we know they're going to come to us, give us a look at it. Maybe they won't give us the lead, but they'll allow us to participate, what have you. So I think that's just as important as specific deal terms.
Yeah, and that's a great point. And I would expand on that to say it's not necessarily just the sponsor entity itself. I've actually had a run of deals where, the quote unquote sponsor was actually a newer sponsor entity that had been started by guys or women who came from a trusted sponsor who had reputation and a history of execution and credibility in the market. And even though their sponsor entity was new, their personal reputations were actually really key, I think, in terms of that trust and that, relationship that they had with lenders. And we executed, on a handful of deals very successfully, and we also, I think, lenders appreciate too that if you are new in the market and you're raising a fund and you want to demonstrate execution, having a lender partner that understands, the importance of that, I think goes a long way towards that kind of, partnership versus contentious relationship. And having, been part of a few of those recently, I can say that, it works, right? I mean, these were deals that in more traditional framework might have been a little tougher, but because of the, reputation and the history of execution of the sponsor partner, these deals got across the finish line in, I'm not going to lie, in record time, so.
Yeah, I mean, the relationship, I think, is key, because it's not only just for a new platform for a sponsor, but just growing an existing platform. I mean, half of the work we do is on add-on acquisitions to existing platforms, and that's just as important to a sponsor as a new platform. So that relationship really matters, because 9 out of 10, you're going to need additional debt to add to for these acquisitions, and the relationship is where that comes into play.
Mm-hmm. Mm-hmm.
Yeah, it is fascinating to hear the lawyers talking about trust, right? Looking outside of the legal documents and trusting each other and building those relationships. But it's true, it's really important. And when you can create that perfect little situation, it is a win for everyone. The founders that have rollover equity, the equity sponsor, the debt finance lawyers and equity lawyers on the deal, and the lender. So it's an important piece of it.
Well, because we're creating a document that is intended to create a relationship, and while the red button is there to hit the event of default and accelerate and likely put them into bankruptcy, nobody wants to do that. It's not good for the lender, certainly not good for the owner, and not good for the company. So finding lenders, again, do you trust them? That's often something we'll talk about, is how do you feel about these guys? Well, I don't know them really well. It's the first deal we've done with them. Or, yeah, we know these guys. That we know how they're going to work with us if something goes wrong. That's something we talk about, with our lender clients as we're drafting agreements, because there's a different approach.
I think it's not the topic of the session, so I won't go into it much, but I think especially for our lender clients recently, there are some upper, large cap instances of broken relationships that are ending in the court. And I think, folks, if you're in finance, you know what I'm talking about. It costs money, right? It costs money. Litigation is not cheap. It is not ideal. You cannot always count on the courts to come out with, holdings that you think are logical or common sense. And, I think it's just a good reinforcement that, maybe it's funny for lawyers to be talking about relationships, but we're deal lawyers, right? We're not litigators. And it is important because there are real life practical implications of having relationships that are not effective, that are not broke, that are broken. And, when it plays out in the courts and, to a large degree, at least from where we sit, that is not the ideal outcome.
Right.
So let's talk for a minute just about whether or not we think this deal volume is going to continue. I mean, there is just so much activity, as Gerum said at the very beginning. And I think we all know a lot of drivers for that. There's pent up demand. A lot of things didn't move. They got put on hold in the middle of 2020, started to heat up. Q4 2020 was a big quarter for private equity transactions in healthcare, continued into Q1. There's a lot of reasons: nervousness about tax code changes, and a feeling that you don't want to miss out on the peak of the market. So you have a lot of private equity backed platforms who are going through exits, some earlier than the normal expected 5-year hold. You have a lot of founders who didn't think they were ready, but are getting pushed into readiness because it feels like it's the right time for all of those reasons. And there's just a lot of activity. From the lender's perspective, what you're all hearing from your lender clients, are they excited about that? Do they expect it to continue? What's the perspective on just the freneticism really right now on just getting deals, diligence, papered, closed?
You want to take that, or Gerum?
Gerum, do you want to?
The one thing I would say is, I think no one really knows the number one driver for this deal volume. Amber, I think you mentioned several things that probably are the drivers behind why we're seeing so much activity. But from our lenders' perspective, they really just don't know if this is temporary or if this is going to be how the next couple of years are going to roll out. So, I think everyone is generally happy. Save for the fact, you may not have a July 4th holiday. You may be in front of your computer for the next few months. But outside of that, I think they're generally excited to see this deal volume, especially coming out of how 2020 went. So,
Well, and cost of funds are cheap now, meaning cost of funds to private equity to get debt capital is cheap, and it has been cheap for a long time. So I think we have to watch that and see how that changes. But even then, there's still be those deals where you're willing to pay, higher rates, higher fees just to have, some debt capital in the stack. So, I think all of our clients collectively would like to see a lot more deal volume. Even though the pipeline is strong and there's a ton of activity, there's still so much debt capital available. It's competitive still. So, I don't think we're going to hit a point where supply of deals is beating demand to put debt capital to work for a long time.
Yeah, just stepping back for a minute, I think, the sense is that there's been a buildup of liquidity, whether it's on the balance sheet of strategics, whether it's located in private equity, whether it's in portfolio companies, over time. And obviously with the pandemic, there's been a blip on it. But if you watch the stock market, it's clear that there is still liquidity and capital in the market. And I think, it's just like anything else. It's just hard to predict, right? I think absolutely everything that Gerum said in terms of the drivers of, deal flow, I think, and the point that Raj made, I think our clients would like to see continued deal flow. Obviously, they're all thrilled, right, with the level of activity and, the deal volume that they're seeing. There's always appetite for more. And it's just a question. It's just, I think, one of those things that it's just hard to predict what that's going to look like in the future.
Yeah. Yeah. And I'm always looking for, in 2008, there was a specific set of circumstances which crashed our market at the time. So I'm always thinking, is there something in leveraged finance or otherwise that may be that same, tipping point? And I don't know, I'm not smart enough to know what it is. And I would love to hear more, economists' views on that. But I don't think we've recognized it or at least identified it just yet. But I'm worried that there is something like that in the future.
Yeah, unfortunately, if you're in a bubble, usually you don't know you're in a bubble until it's over and
So,
Yeah.
we're on the other end.
Right. Yeah.
yeah.
Well, let me just turn us to two quick questions. We could talk about this all day, and I'm loving the conversation, but really want to talk about healthcare niches really quickly. And Raj, I'll ask you this question. Is there a particular area, and I have my guesses, where lenders are really focused right now? They really want an asset in a particular niche of healthcare. I'm guessing it is more digital telehealth, the more remote wearables, all of those things that were on the rise and of supreme interest, and then obviously got dramatically accelerated through the pandemic. And certainly that's where the private equity sponsors are focused, even if it's just an add-on component to a traditional services deal. So that'd be my guess, but I'd love to hear what you are hearing of areas of interest versus those that are really just not something where they're wanting to focus right now.
Yeah, I think med tech is something certainly that we're seeing investment in, specifically in telehealth or wearables. I don't know that our healthcare life sciences folks would see it. That may be in sort of technology silos or some hybrid of the two groups within specialty lenders. I think where we're seeing it is where we have seen it for a long time. We see a lot of volume in home health and hospice still. See a lot in behavioral and therapy. We still see a lot of physician practice management for certain lenders and in certain states. It's a lot of what we've been seeing before: labs and contract manufacturing. It's stuff we've been seeing. So it's kind of going back to the usual. I don't think we've seen specifically any in the lower middle market, a lot of uptick in that telemed and, wearables and things of that nature. That may be even larger market. Quite honestly, it may have skipped us, or it may be below at this point in terms of being more angel. But, right now, in terms of where we sit, I don't see a ton of that, but I don't know if that's different for you two.
Yeah, no, we are. I think we're seeing a lot of that. We're seeing a lot of over-the-counter type products. I think the one driver that we look at, or the one indicator we look at, is what are the multiples people are willing to pay for. And I think home health care, for example, is where it's still in the 20 or above 20 times. So like the traditionals, as Raj said, are still the strong drivers, but we are seeing a lot of some new items coming in, but the traditionals are still the ones I think that are ruling today.
Well, I cannot let you all escape without talking a little bit about the lasting impact of the COVID-19 pandemic on the healthcare debt markets and doing deals from lender perspective. So I think it almost goes without saying, but I'll do it anyways, that our deal documents will be forever changed. I mean, there are certain new reps, force majeure clauses, et cetera, that it doesn't matter what kind of contract you're drafting, from your credit facilities to equity documents to employment agreements, that will be forever changed. But I'm really curious as to your perspective on how you see lasting impacts from the pandemic in terms of diligence processes and extra risk mitigants for lenders and deal documents. Any other perspective? I think that's one of the most interesting elements of the pandemic is the impacts that you could sit here and recognize in the middle of 2020 and those that you're just now understanding now that we're sitting here in the middle of 2021. Raj, I'll start with you.
You start with me.
I'll start with you.
Yeah, look, I mean, I think one thing that we're still trying to wrestle with, and lenders are still trying to wrestle with, is how do we treat pandemic-related issues, right? Whether it was business ended, surgery centers could not do, optional procedures. you couldn't see patients. I think a lot, and so that shut down revenue. And yet there was massive pressure on many lenders not to take traditional remedies, to accelerate, to go into bankruptcy, put companies into bankruptcy. There was a lot of money coming into the system from the government, which propped up companies for much longer than any of us imagined. I mean, in March of last year, we were calling our restructuring lawyers saying, get ready. And the next month, hold tight, it's coming. And then all of this money came into the market and they had a really slow year. I mean, it was staying aware and abreast of the issues that were happening to the borrower companies that were, in the portfolios, but there was not a lot going on. I think we're going to see some of that happening as the government funds stop. Gerum, I think you have seen, some of the back ends of the Medicare advance payments and some of that. So I think we're still working through it.
No, that's right. I mean, for example, on the Medicare advance payments, I think when the program started last year, we knew recoupment would start this year, and our understanding was it was going to be a pretty fast and furious recoupment schedule. But what has actually happened is it's a much more slower paced recoupment. I think it's like on a 11-month schedule or something to that effect. So it's what it has done, at least on the ABL side for service providers, is for a long time they weren't really borrowing at all because they had all this cash sitting and didn't really need to borrow. But as this recoupment has started, now they're starting to use their lines again. So we're getting back to formula, pre-COVID formula. We're not there yet, but as the recoupment picks up through the next 11 months, I think we'll see us going back to the pre-COVID era. I mean, one other area is on like new acquisitions. We still see requests for COVID-related adjustments. And lenders typically get comfortable with it as long as there's historical period pre-COVID that sort of indicates how the company was performing pre-COVID and is performing after COVID. But that's still, conversations to be had in the initial stages.
Yeah, because we're not open fully yet, right? So we don't know.
Right.
We don't know if revenue will look like pre-COVID revenue, and if EBITDA. I mean, there were one-time adjustments. That's fairly common, but will it come back to the same levels? And that's something that's still to be determined.
And I would say, one thing that I think has come about because of the money, the relief money, in whatever form it took, right? Whether it was a PPP loan or whether it was a Medicaid advance. I think one thing that I personally have noticed is I think it's always been sort of held that, private equity and government are not necessarily, the best roommates, if you will. And I think that's sort of been reinforced. And it's just sort of interesting because, from a lender perspective, we may have made, accommodations in our documents and the underlying contract, right? For COVID adjustments, if there was a PPP loan and an add-on acquisition, of course, you're going to deal with it. But, in many ways, if those items were handled properly in compliance with government regulations, I think for our lenders, it wasn't quite as big of a deal, I think, as people thought it might have been, right? Because frankly, everybody was in the pandemic. Everybody was encountering challenges with their business. I mean, and I think that's why we didn't see the huge uptick in the bankruptcies that everyone was predicting, because literally the bankruptcy courts, I don't know that the court system would have had the capacity to handle all of the bankruptcies, right? Because there's sort of a structure and a process that goes with it. There's, an expectation of capital that can come in to help finance, a bankrupt entity through its bank, if they're doing a reorg. And so, I think what's interesting is just, based on what I have observed, in some ways, obviously the government support was critical to a fair number of businesses being able to, stay in business. But by the same token, I sort of wonder if it's less of a permanent change from a lender perspective, than it might be for, on the private equity side. Because again, from a lender's perspective, if everything is done in compliance with, government regulation, I mean, the intent of that was supposed to be temporary support, right? It wasn't supposed to be a long-term subsidy. You got a PPP loan, you applied for forgiveness, you get forgiveness, you move on, right? It's sort of net neutral to the business. And, to Gerum's point about the advances, right? The recoupment schedule, right, is much longer than people realize. It has, much less of an immediate impact on the day-to-day of the underlying business. And so to me, it's just, in some ways, at least, and this is just my perspective, while we all struggle to figure out how to properly address the pandemic-related relief in our underlying contracts, that's, a struggle that we all engaged in together. And I feel like everyone was, cooperative about it. And now it's just a question of whether or not it's going to have long-term impacts. And I think that's an open question from my perspective.
I would agree. I share your perspective, certainly in the optimism and how everyone worked together. We are certainly still dealing with deal conundrums, right? You're ready to close your deal, and the SBA lender hasn't opened their forgiveness portal for this particular phase, and you want to close your deal, and now you have to deal with it. But there are guidelines. People have worked through it together. People have figured out how to get deals done. So thank goodness, because we are all deal lawyers, and that is what we do and what our clients do. So I want to thank you all three, Raj, Naho, Gerum, for joining today on Healthcare Headlines. I love having the perspective of the lender and having my partners on, and wish you all a great day. Thank you.